going to dive into the Tax Cut and Jobs Act. And honestly, I have to say there probably hasn't been as good a time to be in our business as it is today. And I think many of you would agree. There are just so many opportunities for us to be of service to our clients. In today's presentation, we're not really going to take an exhaustive tax code kind of look at the changes. After all, we're in the advisor development business. We drive business alpha. We're not in the tax preparation or TurboTax business. So we're going to spend the next little bit of time with you talking about some of those changes and how they're going to create marketing opportunities for us with our target audience. So let's dive right in. And as Jay said, if you've got any questions along the way, feel free to pipe those into the question box on the right-hand side. So just to level set, the Tax Cut and Job Act's key provisions include a reduction in most of the marginal tax brackets, and we'll get into detail on that in a second. It nearly doubles the standard deduction, and there's a $10,000 cap on SALT, as we all heard during the debate. The Tax Policy Center says most folks are going to see an increase in their after-tax income. It is possible that some folks are going to see an increase in their taxes as a result of this tax bill. But I think most of our clients are going to get a little bit of relief. Now, please keep in mind as we get into the planning portion of this presentation that there is sunsetting that may occur on these personal tax law changes after the year 2025. Congress would have to extend the personal tax reform changes in order for those to stay in force. So keep that in mind as you're doing your planning with your clients. So we talked about tax brackets, and this is kind of an important jumping off point for couples filing jointly with over $100,000 in taxable income. Their tax bracket is going to fall from 25 to 22%. And I think for most of us who have been in the business for a while, that's about as low as tax brackets have been in our lifetimes, honestly. If you're a single taxpayer, you're probably going to see your tax rate fall from 28 to 22% again for that same $100,000 level. And that's kind of an important planning perspective, as you'll see in just a second. With respect to personal standard deductions, if you're married filing jointly, it's going to move to $24,000. A lot of those miscellaneous itemized deductions are going to phase out, and a lot of folks are just going to skip all those itemized deductions completely because the standard deduction really is going to be the way to go. One of the things that didn't change, and this is a nice talking point for you to keep in mind, is the Medicare Surtax on investment income. So essentially, this is an additional tax that high earners, folks married filing jointly who've got modified adjusted gross income of $250,000 and above are going to pay. It's triggered by investment income such as capital gains, interest and dividends, and rental income. So it's an additional tax on top of those tax brackets that we saw just a second ago. It is not going away. So it's still going to be there and still is an important talking point for those affluent families that you may want to come in contact with. One of the other non-income tax changes that came down the pipe was with respect to estate tax. And the estate tax exemption was essentially doubled from $5.6 million. In other words, I could pass $5.6 million estate tax free. Now I can pass $11.2 million estate tax free. This is a terrific planning opportunity for what we're going to dive into now, which is Roth conversions. And you remember I said tax rates are pretty low today. Well, in the words of one leading tax analyst, he believes we've hit rock bottom. It's hard to imagine, with the debt that we have, that we would ever be able to get any lower. So with tax rates this low, many of you may not have ever talked to clients about Roth IRA conversions, but Roth IRA conversions can be attractive. They essentially convert a taxable IRA into a tax-free IRA. The taxes are paid today. Growth is tax-free after the conversion. So going forward, the IRA grows income tax-free. Roth IRAs are not subject to minimum distribution requirements. So that pesky RMD goes away, and any proceeds will pass tax-free, income tax-free, to the beneficiaries. These vehicles are really designed to maximize their benefits for future generations. That's really what they're designed to optimize. I'll gladly pay you today for tax-free benefits to the kids and grandkids tomorrow is essentially the way to think about it. And so families with large IRAs or pensions will probably have an interest in learning more about Roth IRA conversions. And so Roth IRA conversions are a talking point that you can use to engage clients of a more affluent bilk. Your advisor development consultant here at InsureMark has very specialized tools to help you analyze these, and we really encourage you to use those tools as you start to engage clients in conversations about Roth IRA conversions. Between the combination of higher standard deductions and lower tax rates, that's what's really driving the conversation about Roth conversions. It's going to make it a lot less taxable. And you may want to think about the tax bracketing. So someone may be able to take some Roth IRA conversion up to a point without jumping out of a 22% tax bracket. And so you can kind of manage that. And so it may take a period of years for clients to do smaller Roth conversions as opposed to doing one all at once. And so that's a strategy that may make some sense with your more affluent clients. One of the other interesting things about them, besides the tax-free income, is that they are free of estate taxes for most folks now because of this increase in exemption. And so, if you think about it, communicating with a group of clients, communicating with a group of prospects and saying, hey, are you interested in talking about ways to make your larger IRAs income and potentially estate tax-free? Let's sit down and have a conversation about how that works. I think you can see why we believe this will be more of a lead magnet, if you will. One of the things that did change was Roth Recharacterizations. They've been repealed. And essentially, if you aren't familiar with recharacterizations, they were a do-over. They would allow a client who did a conversion today and saw the value of the investments that they had in their account fall, in their traditional IRA account fall, they would have the opportunity to do that over after a period of time. One of the other things to think about because of this increase in the estate tax exemption is that gifting now becomes a lot more attractive. So there will be families where the children could gift to the parents for the purpose of paying the taxes to do a Roth IRA conversion. Again, work with your advisor development consultant to prepare that and prepare that work.